If your money isn't working for you 24/7, you're already falling behind. Traditional savings are a trap. But here's how to make your money work harder than you do. We've all been taught to save, wait, and hope. But while our money sits still, somebody else is getting richer, and that's not by accident. Today, I'm revealing one of the best kept financial secrets, intentionally hidden to keep you stuck in the rat race. And more importantly, I'm going to show you exactly how to break free from that cycle and to use this strategy to your advantage, no matter where you're starting from. This is not just a theory. It's a system that the wealthiest families, businesses, and even the banks themselves have been leveraging for generations. Now it's your turn to learn the truth. My name is Liz, infinite banking expert with the Cash Compound, and today I'm breaking down what we call the save and spend system, also known as infinite banking. By the end of this video, you're going to learn how to save and spend your money at the same time, how to recapture the money you normally spend on things like cars, and how to even pay off your debt super fast. This concept is going to challenge everything you've been taught about money, but once you see it, you can't unsee it. So stick around, because this might be the most important financial information that you'll ever come across. I can tell you this system completely changed how I think about money, and more importantly, how I use it. I get it, money isn't everything, but we all need it to live. So it's not just about getting it right, it's about avoiding the things that keep us stuck. And I'll be honest, when I first understood this concept, it forced me to rethink how money really works. And now I help others see what I wish I had known years ago, that the way we've been taught to handle our money has been setting us up to fail from the start. I used to believe the answer was simple: work harder, save more. But every time I paid a large bill or made a big purchase, it literally felt like I was right back at square one. It was like no matter how hard I tried, I could never really get ahead. And that got me thinking, does this even make sense? And more importantly, who really benefits from this? I started asking the right questions, and the truth became impossible to ignore. The wealthy do not play by these rules. They keep control of their money. They don't take unnecessary risks, and they're very financially educated. They know exactly how to make their money work for them 24/7. And today, I'm showing you exactly how they do it. No matter where you are in your financial journey, my goal is to help you rethink how money really works. Because once you do, everything changes. This is not a sprint, it's a marathon. And it starts right now with some education. Since we're here to talk about money, let's get one thing straight. What is the definition of money, really? At its core, money is just a means of exchange. It's not about the paper in your wallet or the numbers in your bank account. It's about what money allows you to have: food, transportation, security, but most importantly, freedom. Where you put your money matters. It needs to be safe, accessible, and constantly growing in value without being eaten away by taxes, inflation, or random losses. The bottom line is, your money should be working for you, not the other way around, and that's absolutely possible. So let's start by looking at a real-life example. Banks. We all use banks, right? Think about your bank. This is where you deposit your money, trusting that it's safe, and hopefully it's growing. But here's a question. Is your money really working for you, or is it working for the bank? Let's imagine this. You've got $50,000 sitting in your savings account, earning a solid 4% annual interest rate. And I know that's better than any savings account today, but hey, this is a special bank. Your money is growing while it sits there. But then life happens and you decide you want to buy a car. At this point, you have two choices. You can either withdraw the $50,000 to pay cash, meaning you stop earning that 4% interest, or you can take a loan from the bank at 6% interest while your $50,000 keeps compounding and growing? Most people think, no way, why would I borrow at 6% while I'm only earning 4%? I thought the exact same thing. On the surface, this sounds like a losing deal, but the math tells a different story. Option 1, you pay cash. You withdraw $50,000, your account drops to zero, and you lose all future growth. You're starting over from scratch. Option 2, you take the loan, you borrow $50,000 at 6% interest for 6 years. Your monthly payment is $828, and by the end of the term, you've paid $59,662 in total, with $9,662 of that in interest. But here's where it gets fun. Your original $50,000 never stopped growing. It's been compounding at that 4% interest rate, and it grew to $63,256. You earned $13,256 in interest. So if you had decided to borrow the money in option 2, even though you paid $9,662 in loan interest, your account grew by $13,256, leaving you $3,594 ahead. This is where most people get tripped up. And I'll be honest, it tripped me up. I was never a math person. I didn't really get this until I saw it laid out like this, because we were never taught to think like a bank. But the wealthy, they understand this completely. They keep their money working for them, even when they're spending it. So instead of losing your money, you're leveraging other people's money. This is how you beat the system at its own game. Let's think about this for a second. There are 3 crucial questions to ask about money. First, is your dollar worth more today, or will it be worth more in the future? We all know the answer. Inflation makes our money worth less over time. $1 today is the most powerful it will ever be. Second, are taxes going up or down? Think about it. Our government is trillions of dollars in debt. And historically, we're in a low tax environment. So which way do you think taxes are going to be headed? Up or down? Exactly. And finally, would you rather pay taxes on the seed or the harvest? Would you prefer to pay taxes now on a smaller known amount, or later on a much larger unknown amount? If taxes are likely going up, would locking your money away for future taxation make any sense? Of course not. Yet this is exactly what most people do. Take the 401k, for example. Your dollars are locked up, losing value to inflation, inaccessible without penalties, and waiting for future taxes to take an even bigger bite of your money. I mean, really, would you buy a car and just let it sit in the driveway for 30 years? Would you buy some food and just stare at it instead of eating it? Not a chance. But that's exactly what we're told to do with our money. We lock it away. It loses value. We can't use it. And we just hope it all works out for us later. It just doesn't make any sense. And that's why it's time to think differently. Here's another question to help you start thinking differently. Would you rather take $1 million in cash right now, or a single penny that doubles every day for the next 30 days? That penny starts off small, doubling every single day. Meanwhile, if you took the $1 million, it's just sitting there. Or honestly, if you're like me, you probably already started spending it. But look what happens when we let this penny double. On day 15, it's only $163. That's nothing impressive. But look at day 30. That single penny is now worth $5.3 million. That's the power of uninterrupted compounding. If you pick the penny, congrats. You just 5x the million. Most of us, myself included, did not pick the penny. Not because we're bad with money, but because nobody ever taught us the power of constant compounding. We've been keeping our money in places where this kind of exponential growth just doesn't happen. Not because we're financially illiterate, but because we were never shown another way. Now, let's bring in some wisdom from one of the smartest people who ever lived, Albert Einstein. He said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." So what does this actually mean for us? It's simple. If you know how to use compound interest, you earn it. If you don't, you're the one paying it. And paying it is exactly where most of us are. And while we're on the topic of that compounding penny, let's look at another thing that eats away at our money: fees. There are brokerage fees, account fees, or if you're like me, the occasional overdraft fee. Yes, we've all been there. But imagine if our compounding penny had a 2% fee attached to it. 2%, that's nothing, right? Wrong. By day 30, instead of growing to 5.3 million, that penny only reaches 3.2 million. That's over $2 million gone, all because tiny fees chipped away at the money that could have been compounding. This is the real cost of fees. Let's talk about something else we all do with our money: withdrawals. Because we all know money isn't just something we save. It's something that we use. It's a means of exchange. We've already gone over this. But what happens when we withdraw from our compounding penny? Let's say on day 15, we take out $100. That brings our balance down to $63. And then on day 25, we pull out another 100 because life happens. We need to use our money, of course. But that $200 withdrawal cost us $3.2 million in potential growth. That money wasn't there to compound. This is what most people don't realize. It's not just about what you take out, it's about what you lose in future growth. So, we talked about fees and withdrawals, but now let's hit on the big one that we all love so much: taxes. Because we all pay them, they're everywhere, and we can't escape them, and they'll always be there. What happens when we apply a 15% tax to our compounding penny? It slows things down, big time. So much so that we don't even hit 2 cents until day 5. Now in total, we'll only end up paying $182,000 in taxes, but that 15% tax cost us $4.8 million in lost potential growth. So instead of ending up with $5.3 million on day 30, we're left with just $589,000. Are you seeing the pattern here? Every little thing that can interrupt compounding, fees, withdrawals, or taxes, takes a massive toll on your money's ability to grow. And most people never even realize this. Now let me ask you this. What if there was a place where your money could grow with constant compounding without being eaten up by taxes, with fees, or withdrawals? Wouldn't you at least want to know where that is? Because if you've been paying attention, you're starting to see the pattern, that the way we've been taught to save and invest is costing us more than we realize. But what if there was a better way? Let's keep building. Before we move on, we must talk about one of the most powerful institutions in the world: banks. They've been winning for a long time. And once you see how they do it, you'll understand exactly why this matters, especially when it comes to infinite banking. So let's break it down with a visual. Imagine you have $100,000 in savings. Like most people, we're going to deposit this into the bank because we're taught to trust banks for safekeeping. But historically, the real reason we put money in the bank is to earn interest on it. Now let's say we went back to that special bank that gives us 4% interest per year. Since the bank promises us 4% interest, they now owe us $4,000 on our $100,000 deposit. To the bank, this is a liability because they have to pay us that 4%. But the banks don't just let that money sit. Banks are in the business of lending. They put your money to work in the form of a loan to somebody else. They don't lend your $100,000 at 4% either. No way. They charge more on that when they loan it out, of course. And this difference is called the spread. Let's say they lend it to the person behind us in line at 7% for a home loan. Suddenly, what was a liability becomes an asset to the bank. And this is because the borrower now owes the bank the full loan amount plus interest. And once the borrower buys the house, that money will go right back into the banking system when the seller deposits their money back into their own account. And the bank now has another liability. So what do? You already know. They lend it out again. This time for a car loan at 8%. The buyer pays the car dealer. The dealer puts the money back into the banking system. And the cycle keeps going. The bank lends it out again. For a home remodel at 9%, the contractor gets paid and deposits it back into the bank. And of course, the bank lends that out again, maybe for debt consolidation at 12%. So what's happening here? The bank has been in control of our money the entire time. They've used our deposits to fund these loans while taking on almost zero risk. And how do they offset any risk at all? By charging interest on every single loan. No matter what happens, the bank is always making money because they control the system. You've probably heard the saying, whoever has the gold makes the rules. And in this case, the banks have the gold because we handed it over. So let's see just how much the bank has made off of our money. For the first loan at 7%, they made 3% profit because they're paying us 4, but charging 7. For the car loan at 8%, they're making 4%. For the home remodel at 9%, they're making 5%. And for the debt consolidation at 12%, they're keeping 8%. So we're gonna add all these up. 3% plus 4% plus 5% plus 8%, that equals 20%. The bank made 20% on your deposit, while you only made 4%. Think about this. How much more did the bank make compared to you? If you guessed 500% more, you nailed it, because 20% is 5 times more than 4%. I used to think, wouldn't that just be 16% more? But we have to look at the actual dollar amounts. The bank pulled in $20,000 while we only made $4,000. That's a 500% difference. The bank made 5 times what we earned, all by using our deposits. And while they were out there multiplying it, we couldn't even touch it. It was locked up, unable to use it, earning 4%. The bank never used their own money. They took on zero real risk, but stayed in complete control. All they did was move our money around and collect profits. We financed the cars, the homes, the remodels, and they took the profit. This is the game that they're playing with us. So what's the only thing missing from this whole scenario? It's the entire point of this whole video. It's that we were not the bank. Yes, it was our money being used. Yes, we bought the homes, the cars, and everything else, but we were not the ones controlling the banking function. Now imagine if we had been the bank. Imagine if we were the ones profiting off of our own debts, expenses, and everyday purchases. Instead of handing over all of that money to the banks, we could be the ones benefiting from the profits of our own dollars. So why keep playing their game when we could be the bank instead? What if you could stop locking up your money, stop giving up control, and start keeping the profit for yourself? Would you want to know what the ideal asset is for constant compounding? No issues with taxes, fees, or withdrawals? And that keeps you in total control? Well, let me tell you what that is. It's a dividend-paying whole life insurance policy from a mutual company. Now stick with me. I know that was a lot of words, and if you're anything like me, you're probably thinking, wait, what? I remember the first time I heard this, I literally did a double take. I didn't even really know what I had just heard. I was just thinking, hold up. I thought we were talking about building wealth, about banks. We were just talking about numbers and the save and spend system. Like, we're talking about infinite banking, right? But now we're talking about life insurance. I don't know anything about life insurance. I'm not even thinking about dying. I want to live, and I want to be rich while I'm alive. That's why I'm here. I'm confused. I get it. I know it sounds weird at first, but keep an open mind because here's the reality. This isn't a new strategy. It comes straight from the book, Becoming Your Own Banker by Nelson Nash. This book is the blueprint, and it's the exact strategy that I teach today. Dividend-paying whole life insurance has been used by the wealthy for over 200 years for the purpose of banking. This isn't some new trend. It's a guaranteed contract that works every single time. And it's not the traditional life insurance you're probably thinking of. It's more like a personal banking system. It's about being in control of your money. It's about making your dollars do more than one job. It's about keeping the profits for yourself instead of handing them over to the banks. This is infinite banking. And if you're serious about learning this, Becoming Your Own Banker is a must-have in your library. So I hope you're able to see beyond just the life insurance label and are actually able to see the bigger picture, because the bigger picture is not about life insurance. It's about banking. Infinite banking is a process, not a product. So how are we going to do this? It's simple. We're going to follow their lead. And I'm going to walk you through exactly how in the second half of this video. Here's the thing. Whole life insurance from a mutual company is the ideal asset because it gives us growth, guarantees, liquidity, privacy, and best of all, it gives us the ability to save and spend our money at the same time. This is a tried and true system, one that has been around way before the Civil War, and some of the wealthiest families and business leaders in America have been using it for generations. Take a look at this list. Walt Disney, the Rothschilds, the Rockefeller family, Ray Kroc, founder of McDonald's, James Penny, founder of J.C. Penney. These aren't just names from the history books. These are people who built empires using this strategy. They leveraged these policies to finance their businesses, to pass down generational wealth, reduce their taxes, and keep money within their families. But this is not just for wealthy individuals. It's also businesses, especially banks. And here's a fun fact. Your bank, one of the most powerful institutions in the world, owns more of this kind of life insurance than they do land or real estate combined. It's known as BOLI, bank-owned life insurance. If you go to usbanklocations.com, you'll see that all the major banks in this country own billions of dollars in whole life insurance policies. That's billions with a B. Banks don't just use this strategy, they heavily practice it. And I'm going to show you how you can too. So ask yourself, are these banks making a dumb decision? Or do they know something that we don't know? This is exactly what we're teaching here. And it's exactly why infinite banking is not just another financial strategy, it's the strategy. Let's keep going. Since we're talking about life insurance, I want to be really clear. There are a lot of different types of life insurance out there, but we are only talking about one kind, and that is dividend-paying whole life insurance from mutual companies. If you're thinking about term life insurance or any of the other kinds, nope, that is not what we're using, for two big reasons. Reason number one, they have not been around for 200 years like whole life insurance has. And reason number two, banks and the wealthiest families in this country do not use them for banking. And we're here to bank, not gamble. We're intentionally designing whole life insurance policies that participate in the profits of mutual companies on purpose. These policies are built for high cash value today, so you can actually use them to become your own bank. And let me just say this, Not every life insurance agent knows how to do this. Your brother-in-law who sells life insurance? Yeah, he's got no clue. He'll probably look at you like you're crazy. In fact, most agents will never have even heard of this strategy, let alone know how to structure a policy correctly for banking. That's why it's so important to work with somebody who actually knows what they're doing. An authorized infinite banking practitioner, myself, or the coaches at the Cash Compound will make sure you get the right design for your banking needs. This isn't about buying life insurance. It's about building a private banking system, one that gives you control, growth, liquidity, and profits. That's why this is the save and spend system, and it's exactly how you become your own banker. All right, so how does this actually work? We break it down into the 3-cup setup. This is a simple way to visualize what's happening inside of your banking policy, where your money goes, where it comes from. So let's take a look. Cup number 1, the red cup. This is where your premium goes. Think of it as your deposit to the insurance company. And what does your premium do? It buys insurance. Specifically, it's buying your death benefit. Whether you pass away tomorrow, in 10 years, or 105 years old, the policy must pay out. And when that payout happens, it will go to whoever you choose. It will get paid out, income tax free. This is not money that you're losing. It's money that's building something. It's building your financial legacy. So cup number 1 is where your premium goes. And I want you to start seeing this as your new savings account. Cup number 2, the green cup. This is your cash value. Think of this as the net now of the future gross benefit. Your death benefit is for the future. It's guaranteed to pay out one day. But while you're alive, every time you make a premium deposit into cup number 1, your death benefit and your cash value both grow. So what is cash value? This is the equity inside of your policy. It's essentially the loan amount you can leverage against the death benefit that the insurance company owes you anyway. Realize this: premium cup and cash value cup are 2 separate pools of money. Understanding how they work together is key to how you become a successful banker. And the 3rd cup, the blue cup, this is your death benefit cup. This is the larger pool of money your deposits have purchased for a later payout. So when you borrow against your policy, you're not withdrawing money from your deposits in cup number 1. Instead, you're accessing cup number 2, your cash value. This happens in a form of a loan. And again, remember, these are 2 separate pools of money. In this process, you'll loan those dollars to yourself and repay them back at your own pace. Your repayments then replenish cup number 2, your cash value, which in turn restores your death benefit. The best part, the moment you repay your loan, those dollars are immediately available for you to use again. This is why this setup is the most ideal place to store your money. Did you notice the dollars we put inside cup number 1, our premium deposit, never went down, even though we took out a loan? That's because our dollars never actually left our account. It was a loan against our policy, not a withdrawal of the dollars that you put in. Your money stayed safely inside your new savings account, cup number 1, while you were still able to pay for what you needed and for what you wanted with cup number 2. As we repay our loan back to the insurance company, what happens? It replenishes what they owe us, our death benefit, and just like that, those funds are liquid again and available for future purchases through our cash value. And if we choose to become an honest banker, which is what we teach, we wouldn't just repay our loan, we'd repay ourselves back with interest, just like we would at a traditional bank. But this time, instead of the bank profiting off of us, we're paying ourselves and profiting. That extra interest we choose to pay ourselves, it doesn't disappear. It goes right back into our banking system, inside of cup number 1, our premium deposit. This naturally buys more insurance, which increases our death benefit, and builds even more liquid, usable cash value. And we can access it anytime, with no penalties, no restrictions, and no questions asked. And let's not forget, we're using dividend-paying policies from mutual companies. This is a key component to what makes the system so powerful. Unlike publicly traded companies that answer to stockholders, mutual companies do not have stockholders. Instead, they're owned by us, the policyholders, which means when the company earns a profit at the end of the year, who gets a share in it? We do. These profits are distributed back to us as dividends. And what do we do with these dividends? We put them right back into our cup number one. Those dividends do not just sit there, they go to work for us. They buy more death benefit, which boosts our cash value, which means more money that we can access and use however we want. And by keeping our dividends inside of our system, we're stacking even more money on top of our money, continuously compounding and growing in our favor, all without interruption. And did I mention the dollars in cup number one come with 3 guarantees? Number 1, your premium is fixed and level. It's never going to go up or increase as you get older. Number 2, your policy guarantees a death benefit payout. No market crashes, no uncertainty. It's a contractual guarantee. And number 3, your money never moves backward. It's not invested in the stock market. This is a safe, stable asset. We bought insurance. We didn't make a risky investment. And that's a huge distinction because it means that we are in control. Your normal bank does not work like this, not even close. Hit that like button if this is making sense, and let's keep going. So we've covered how banks really work and how they profit off of our money. We've also broken down how most people finance a car. We'll also be going over how to use the strategy to pay down your debt super fast in a way that's going to recapture every dollar you normally lose to creditors. But now, let's walk you through the exact process of how to use policy loans from your own private banking system to purchase a car. If you look at the third column, it's labeled Policy Premium Deposit. In this example, this person decided to contribute $2,000 a month, adding up to $24,000 a year. As soon as that first deposit is made, he's securing himself $596,000 in death benefit. And $13,921 of that is immediately available in cash value, meaning he could access that money right away if he wanted to. It's his money. He controls it. But in this example, he chooses not to touch it just yet. He's building it up to make a bigger purchase down the road. Fast forward to year 2, he adds another $24,000. Now his total death benefit is $638,000, and his cash value has grown to $28,386. By year 3, he deposits another $24,000, bringing his death benefit up to $681,000, and his cash value has grown to $50,858. At this point, he's built up enough cash value to make his purchase, and that's exactly what he does. He calls the insurance company and takes a $50,000 policy loan to go buy a car. Now, just to clarify, this does not mean he withdrew money from his policy. His money is still in cup number 1. Instead, he's borrowing against it using his cash value in cup number 2. The $50,000 gets deposited into his regular bank account, and from there, he heads on over to the dealership to make his purchase. Here's where the real shift in thinking happens. Normally, a bank is going to control this entire process. If he had borrowed this money from a traditional bank, they would force him into a strict repayment plan with no flexibility. But in this case, nobody forces him to pay it back. He's in control. He is the banker. But he realizes, if he doesn't repay the loan, isn't that treating the bank's money as if it's more valuable, just like he would if he would have loaned from a traditional bank? Because his banking system is just as important, if not more important. So he commits to paying himself back $10,200 a year, which works out to about 7% car note. And he sticks with this plan for 6 years, just like he would do with any other car loan. The next year, in year 4, he deposits another $24,000, bringing his death benefit up to $724,000. For the full 6 years, he continues repaying himself back $10,200 annually, just like clockwork. But then in year 6, you see something interesting happen. All of a sudden, his policy premium deposit drops to $9,600. Wait a minute. He was depositing $2,000 a month, $24,000 a year. How is he doing that? Well, he shifted his thinking. He stopped looking at his policy as an expense, and rather, he started looking at it as his own private banking system. He realized that most of us are already depositing way more money than this into our own normal bank account without even thinking about it. And with infinite banking, you control how much and when. After 5 years of consistent deposits, once his system was well established, he made the decision to reduce his deposit to $9,600. This system is flexible. After 8 years, let's look at his total net injection. He deposited a total of $148,800. He borrowed $50,000 to purchase a car, and he repaid himself $61,200 over 6 years. What's this mean? His total net injection was $160,000. But here's what's awesome. Looking at the 8th row, the 6th column, he has $132,603 available in cash value. That means out of the $160,000 he put in, $132,000 is still liquid and ready for him to access at any time. Plus, he still owns the $50,000 car outright. Fast forward, cars don't last forever. Eventually, he needs another car, and this time he's going to use his cash value. He pulls out $55,000 to buy his next vehicle. Just like before, he borrows against his policy using his cup number 2 and deposits the $55,000 loan into his regular bank account. There were no restrictions, no questions asked. It's his system and he's in control. He chooses to repay himself at 7% interest, just like he did last time. And this time it works out to $11,250 per year. And he repays it over 6 years. He gets the car and keeps the money growing at the same time. After this 6-year stretch, he's deposited a total of $57,600 into his private bank. He borrowed $55,000 for the second car, and he repaid himself $67,500. What was his total net injection? That's $70,100. And here's the best part. His cash value has grown to $218,000. That means his cash value increased by $85,000, while he was still using his money to buy cars. He didn't rely on a traditional lender. He recaptured the money he would have lost to interest, and this system kept growing year after year. He's purchased 2 fully paid off cars, while keeping his money compounding and working for him at the same time. He's acted as his own banker, kept control of his money, and leveraged his own system to recapture interest. This is not just debt payoff for a car, it's a wealth building system through his own purchases. This is why infinite banking feels like financial magic, but it's not magic at all, it's just a better system. He now has his money working for him 24/7 while maintaining full control and flexibility. This is infinite banking. This is how you escape the cycle, and this is how you take control of your own financial future. So let's break this down visually with 3 different approaches to money. Here's what most people do. Approach number 1, the saver. If you're a saver, you do the responsible thing. You save up, buy the car with cash, and avoid debt. Great, right? Except now you're back at 0. And the same thing happens when you buy a house, take a vacation, or make any other big purchase. You're constantly in a cycle of saving, and then spending, and then you're starting back at zero. But then there's another way. Meet the debtor. If you're a debtor, you go into debt to buy a car, and then you spend years making payments just to work your way back to zero. Then what happens when it's time for your next big purchase? Whether it's a house, a vacation, or another car, you go right back into debt and repeat the cycle. And this is how most people operate, working hard for their money, handing it over to the bank, and constantly playing catch up. You're stuck in a cycle of debt, never really getting ahead. This is where I was at. What if, instead of being a debtor or being a saver, you became the bank? Specifically, an infinite banker. That's exactly what we're doing here. We're making purchases, we're keeping our money growing at the same time, even as you're taking loans and repaying them. Your principal value never stops increasing. Why? Because your original deposits stay untouched, continuing to compound, uninterrupted. You remember the penny? This never happens in a traditional banking system. Instead of working for money, your money is now working for you 24/7. It's just a better system. This is infinite banking. This is how you escape the cycle, and this is how you take control. Let's keep going. If you're watching this and thinking, buying cars sounds great, but I've got bills to pay and a huge pile of debt to deal with, then this part is for you. This is a money map, and honestly, it's one of my favorite examples because it shows just how powerful infinite banking can be when it comes to getting rid of debt fast. When I first started, my first policy was not for buying cars. Not even my second policy was. It was for eliminating my bad debt. In this example, it's real. This is somebody that I personally know. And at the time, he is starting his journey with $434,000 in total debt. Now, I know there's a lot of numbers on the screen, but just stick with me. Here's what he owed. Visa, $2,900, $3,400 on his Discover card. He had a dentist bill for $5,000, Home Depot bill, $7,400, a $15,000 Best Buy, $16,000 was for Apple, $21,000 for rooms to go, Mercedes-Benz for his car, $45,000, and then on his home he owed $316,000. Altogether, that's $434,000 in debt. But here's what makes it even worse. As you can see, each debt has a required monthly payment, and each one has an interest rate attached to it. And if he kept paying the normal way, he would be in debt for decades. But we're not waiting that long. We're going to clear this debt way faster by using the process of infinite banking. We aren't doing anything extreme. We're not magically making extra money appear. We're simply redirecting our deposits. Instead of handing them over to the bank, we're just going to put them into our own private bank first. Here's how this is going to work. We're going to deposit money into our banking policy. We're going to borrow against our policy in a loan. We're going to use our loan to pay off our debt. And then we're going to repay ourselves back just like we would repay a bank. In year one, he committed to depositing $2,500 a month to his policy. This adds up to $30,000 for the year. Right away, in year one, he had access to $17,401 in cash value. So with that, he got to work. He paid off his Visa, he paid off his Discover, and he paid his dentist bill off in full. He also was able to pay down Home Depot quite a bit, but not enough to clear the balance just yet. Already, he's eliminated 3 debts, freeing up those monthly payments. And here's the point of the whole thing. He's not losing that money. He's shifting his money from liabilities to assets. He's keeping control of his dollars instead of handing them over to creditors. By the end of year one, his regularly scheduled payments wiped out the Home Depot balance too. 4 debts gone in just 1 year. He then had a moment. He called me up. He said, "Liz, I took a loan, paid off my debts, and I feel amazing. Do I have to repay it?" Well, no, you don't have to, but you should. And now that you have extra cash flow every month, instead of sending those payments to Visa, Discover, or the dentist, what if you just redirected that back to your policy loan instead? He agreed. He thought that was a good idea, and he kept it simple. He'd only pay back what he was already planning on paying to those credit cards. No extra effort, no lifestyle changes, just moving his money from their pockets back to his. And that's exactly what he did. From this point forward, those same payments became his loan repayments, building his banking system back up for the next round of debt payoff. Heading into year 2, he made another $30,000 deposit into his private bank. His available policy loan now grew to $18,000. But here's that pro tip. Because he had been consistently repaying himself throughout year 1, his total available funds for debt payoff has grown to $21,000. With that money, he knocks out Best Buy completely and makes a significant reduction, but not fully paid off yet, to Apple. Since he no longer had that $250 monthly payment to Best Buy, he redirects that money back to his private bank as a loan repayment. And I hope you realize this wasn't an extra expense to him. It was just repurposing the money he was already used to spending. And by doing this, his banking system keeps growing and his debts go down fast. I hope you realize this isn't an extra expense for him. It's just repurposing the money that he was already used to spending. Going into year 3, he made his $30,000 deposit into his private bank. His available policy loan grew to $28,000. And thanks to his loan repayments, he had an additional $7,900 ready to use. This brought his total available funds for debt payoff to $36,000. With that, he wiped out Apple completely. Rooms to Go paid off in full, and his Mercedes-Benz got a large payment, but it's not fully paid off yet. In just 3 years, the only debts left were his car and his house. Let's do some quick math. How much did he actually put in? Over 3 years, he deposited a total of $90,000 into his private bank. Meanwhile, he's accessed $63,000 in policy loans to wipe out multiple debts. Now, some of you might be thinking, okay, he put in 90, took out 63. Doesn't that mean he only has $27,000 left? And this is where you need to shift your thinking, because that math does not apply here. Remember the 3-cup setup. His $90,000 in deposits has never left his cup 1. It wasn't spent and it wasn't lost. It's still there. It's still growing. It's still earning uninterrupted compounding interest. That $63,000 he used to pay off his debt, it didn't come from his original deposits. It came from cup number 2, his cash value. So how much is left in his private bank? All $90,000 is still there, compounding and growing and working for him. And here's where it gets even better. In year 4, he deposits $30,000 once again, but this time, something amazing happens. His available policy loan isn't just $30,000, it's $30,101. For the first time, his cash value exceeds what he deposited. The system is now outpacing his deposits and his contributions. Over the past year, he also recaptured $13,716 in freed up payments. This means in total, he now has $43,817 available, ready to be used however he wants. He sticks to his plan, he knocks out his Mercedes loan, and now the only debt left is the big one, his mortgage. With his private banking system fully built, he tackles the mortgage using the same process. In month 37, he makes a $32,000 payment. In month 73, another $33,000 payment. And in month 82, a final $19,000 payment. His mortgage is officially gone. Every single debt is paid off. not in 240 months like the bank had planned, but in just 82 months. He did not just use policy loans to do this. A huge part of his success came from recapturing all the money he was previously sending to lenders. Every debt he eliminated freed up cash flow. And instead of letting that money disappear, he put it back into his private banking system. That's what made this possible. How would it feel to eliminate every single debt that you have in just a fraction of the time the banks want you to? Because that's exactly what infinite banking allows you to do. The best part is his private bank is built inside of a whole life policy, which means even after paying off every single debt, his system is still growing. Now with zero debt holding him back, he could use that money however he wants. He can invest it, save it, retire on it, or make a big purchase with it without ever losing control of his money. This is infinite banking. This is financial freedom. Warren Buffett once said, "If poor people would just do what rich people do, they wouldn't be poor anymore." The first time I heard that, it kind of stung. I thought, that's easy for you to say, you're stupid rich. But the more I studied how the wealthy actually use money, and the more I practiced what the wealthy actually do, the more I realize he's absolutely right. The strategy of infinite banking has been around for generations. The wealthy have been using it and do use it today to control their banking needs, while the rest of us have been told to lock our money away, trust the system, and let the banks make money on our money. So the real question is, now that you know what's possible, what are you going to do with this information? You have two choices. You can forget this information and keep playing by the bank's rules, or you can start taking action today. The choice is yours. Keep playing by the bank's rules or rewrite the rules in your favor. But remember, every day you wait is a day that the bank is winning. Click the link below now to book your free one-on-one cash consultation with me. This is your chance to get personalized answers to your specific questions. You'll see exactly how infinite banking can work for you, and finally, you can start the process to regain control over your money. But remember, do not wait for the system to change. Take control of your financial future, and if you found this valuable, hit that subscribe button so you'll never miss a video. I'll see you in the next one.